I'm Dickinson Bransford, Managing Director with Investment Bank Mid-Market Securities. This presentation is geared toward owners or major shareholders of low to medium volume, high mix, advanced custom manufacturers that would hold ISO 9001 or AS9100D quality certifications, but emphasizing those for whom Medtech manufacturing is a substantial percentage of revenue, i.e. companies that would hold ISO 13485. For quite a while, I've suggested that owners make an active choice about either investing in the future of the company, taking on equity partners to do that together, or divesting. There are several simultaneous forces changing the market, both favorably and unfavorably. Any strategic decisions like invest, divest, or hope for the best, the riskiest option, should be illuminated by this knowledge. I've spent a lot of time analyzing this business, as evidenced by one of my office doors being covered by a strategic and functional mapping of the industry. I'll use 5 standard abbreviations: CMOs for contract manufacturing organizations, EMS for electronic manufacturing services, AI for artificial intelligence, IIoT for industrial Internet of Things, and TSMC for Taiwan Semiconductor Manufacturing Company. Let's get started. Invest, divest, or hope for the best. 15 market forces impact on medtech manufacturers. Let me be clear about the focus of this presentation. It is to describe the forces impacting your wealth as the owner of a company described earlier. It's very bottom line oriented, the bottom line being your future wealth and lifestyle options. Since it's designed to prompt thought and shareholder discussion, please feel free to share the link with your board. Several market factors predating COVID-19 influence medtech contract manufacturing. Obviously, there's current market and supply chain disruption, but I'll focus on the bigger picture, longer-term trends in this presentation. But first, for context, who are we, who do we work with, and how can we help you? I'll save more detail for the end, but even that's light on self-promotion. We offer smaller to mid-sized, mostly US companies, the advisory services described on the slide, which would tersely be described as valuation, mergers and acquisitions, and debt or equity capitalization activity. Our motive's simple: help shareholders reap the greatest return on their invested capital. Our experiences spanned multiple industries. Personally, mine spans healthcare, medical devices, software, semiconductor test and measurement, and a lot of other miscellaneous, now focused on how medtech manufacturing is being transformed by the many forces I'll discuss. Of course, the first priority is ensuring that the company has adequate liquidity and its solvency is not in question. In case it's helpful, I'll draw your attention to an article I wrote titled 16 Immediate Actions Company Owners Should Take to Protect Their Business Financial Health During COVID-19. The right side of the slide lists the 16 topic headings. If you go to thomasnet.com and search my name, you should find it readily. This discussion's critical input to company strategic planning, capital and operational expense planning, and shareholders' personal wealth planning. And of course, in a private enterprise, each of the 3 are interrelated as 3 legs to a stool. If you're considering or open to a transaction, starting the process now may be the best time in the next several years. I emphasize the word starting because that infers being prepared to go to market, even if we agree to institute market value enhancement or corrective initiatives before actually doing so, or just test the waters. For many, this moment in time may provide the chance to avoid a worse fate later. In any market, at any time, the company which is prepared and ready to be marketed for sale or investment will transact at a higher valuation than one which is caught off guard and responsive to unsolicited offers. Being ready avoids having to get ready. But in no case does a transaction happen immediately. Pre-COVID, 84% of lower middle market private transactions that were managed by professional advisors like investment banks, were closing on average between 5 and 12 months after beginning the process, with about 60% taking between 7 and 10 months. The first month or few is almost always dedicated to preparation. 9 factors challenge your equity value. 6 support it. This slide summarizes those factors and the rest of the presentation, which will delve into more detail about each item listed. It's broken into factors which generally would detract from your equity valuation versus those which are supportive of a higher valuation, headwinds or tailwinds. From this high-level vantage point, it's easy to see that there are many important considerations beyond just whether we're in a recession now. If you stick with me for the rest of the presentation, I think you'll probably learn some things you didn't already know and gain some perspectives on things you may have been at least peripherally aware of. Among them, at the micro level, I'll discuss some technologies in your industry that you may not be aware of or thinking enough about them. I'll discuss M&A market valuations and the influence of venture capital. And at the macro level, I'll discuss reshoring, long-term influences of the economy, population demographics, and some geopolitical dynamics critically important to U.S. manufacturing, the overall economy, and U.S. future competitiveness. Note that innovation tidal wave is highlighted. That suggests the point could be either adverse or supportive, circumstantially dependent upon the company. We start with the adverse factors. We're in a deep recession that could last years. Data released late July revealed this to be the steepest downturn in 70 years, with a peak to trough of almost 11%, 10.6% in real GDP output. That's a much bigger drop than the entire global financial crisis a decade ago. JP Morgan's chief asset strategist thinks that GDP could surge as much as 25 or 30% on an annualized basis in this third quarter, following -5% and -33% in first quarter and second quarter, respectively. But we'd still be 5% below the end of last year. Effects of this recession and stimulus to fight it will be felt for many years. U.S. manufacturing activity was declining well before COVID-19, as we know, according to the Institute for Supply Management. This slide shows the past 18 months through July 2020. Over 50s generally expanding and under 50 contracting. We crossed over from manufacturing expansion to contraction exactly a year ago, July, August, shown in the red circle. American manufacturers expanded this July for the third month in a row. And while that sounds good, the index doesn't measure the actual amount of production or tell how much it is improved. It remains depressed. The survey basically asks executives if their businesses are doing better or worse compared to the prior month. Well, naturally, after an economy's been shut down and then reopened, huge numbers of respondents will answer that business conditions, orders, production, etc., are better than they were. Obviously, nobody knows how long the downturn will last or how bad it'll be. Short of a miracle drug, only adaptation mechanisms and social behavior modifications will enable economic turnaround, as the scientific community is concluding that otherwise it's too late to eliminate the virus worldwide. It's spread too far already. There are critical unknowns, unsolvable or unresolvable for a few years. Can immunity be achievable at scale by either vaccine, natural genetic immunity, and/or resolved infection, i.e. herd immunity? If so, how long will it last? Months? Over a year? Forever? Will cold weather enable the virus to spread further, faster, seasonally? It's encouraging that there are 26 vaccines in human trials, 12 are in phase 2 and a half dozen in phase 3. On the other hand, nobody's been able to develop a vaccine for HIV or even malaria, which is preventable and treatable, yet kills 400,000 people annually. The so-called Spanish flu of 1918 killed far more Americans in the fall than the prior spring. As this survey indicates, economists were almost equally split in May on whether we should be reopening businesses. just as people are now split on schoolroom teaching. Uncertainty is our new normal and will be for some undetermined time. The longer it takes us to reduce our transmission rate or flatten the curve, short of a miracle drug, the more likely this chaotic new normal state will last for years, not quarters. The Bipartisan Congressional Budget Office is a reliable data source. As distressing as a decade to regain lost GDP is, I don't find it surprising based on prior comeback patterns and what we still have to accomplish to resolve the health crisis. Predicting a miracle drug, scaling manufacturing production as soon as possible to vaccinate the world while suppressing the counterfeit market, these are big challenges to get us out of the hole. In my opinion, hope for a quick turnaround is just that, hope. Let's not lose hope, but as stewards of multi-million-dollar enterprises employing a lot of people, realism is key. Don't confuse the real economy, this view, with the stock market. As we see daily, its performance is altogether divorced from what we know to be happening to businesses and jobs. The longest economic expansion in history just closed, as did inflation to M&A valuations. For the past decade, M&A deal valuations continued to rise. Look at the overall trend line showing middle market transactions, enterprise values to earnings before interest, tax, depreciation, and amortization, abbreviated EBITDA, multiple for the past decade. It's a pretty clear linear upward slope. The private M&A market has moved in fairly predictable cycles for the past 40 years and is influenced by the broader economy as indicated by the GDP trend line and context notes beneath the years on the graph. It favors buyers, shown in pink, for a few years, then sellers, green, then shifts to a period of uncertainty, yellow, before repeating. It's not absolute, but the uncertainty and buyer-favored cycles each tend to be around 3 years, and external stimuli like the growth of the internet, dot-com crash, or COVID-19 sure play a prominent role in shifting the market. The green seller's market cycle was nearing its end as we were already moving into the yellow uncertainty zone before our economy was tipped into recession by a demand shock. In other words, the total sudden cessation of demand. A textbook example of the converse, a supply shock, was the 1970s oil embargo. Not surprisingly, the M&A market almost froze, but is starting to adapt now. Before COVID, that historic trend was suggesting that in 2021 or two, there would be a shift to a buyer's market for a few years. A likely upcycle again would occur somewhere around the mid-decade, 2024 or 5 through 28. Of course, there's higher uncertainty now. So, in any case, pretty far into the future for the many private company owners who had delayed retirement or other next step in life plans while the market was so robust. I wonder how many will want to gamble that far out on the possibility that another seller's market will materialize then. As factors I'll soon discuss indicate, even if so, it's highly unlikely to be as robust as the past decade. As you can see from the first red circle, most in a January finance community survey expected the economic cycle and seller's market to end this year or next. So most sophisticated investors and acquirers were already pricing recession adversity into their perceived valuations. The second circle highlights that they were also concerned about extreme market valuations. So what's the result of that? The two combined had already depressed deal volume well before COVID-19. Higher prices extend the payback period. There's no risk cushion. Everything's got to go right for a deal to pencil out for the investor if it's at an extraordinarily high valuation. Well, sellers had seen valuations continue to climb for years, and human nature being what it is to extrapolate that into the future. So the gap between buyers and sellers' expectations just continued to widen. But M&A deal count may begin rising again for four reasons, most notably that valuations are less lofty and slowly people are adapting. For instance, using video conferencing for some of the due diligence that would have been done in person. Supported by reasons I'll discuss later, I predict that the valuation range that'll close most transactions will return to historic norms, adjusted for COVID risk, not become a disaster for sellers. What do investors seek? They want companies that are insulated from recession via recurring revenue, proprietary and highly differentiated offerings, technology, patents, or other characteristics of high quality businesses like lack of customer concentration. This isn't to say that absent all these characteristics, businesses won't sell or be qualified for investment, but the more of them, the more desirable the company for sure. Consolidations of fragmented industries, like CMOs, are often the result of well-funded acquirers seeking economy of scale for cost reduction, skills, or technologies they don't already have, or market power. Over past years, we've been seeing continual CMO and EMS consolidations as acquirers / investors execute buy and build strategies, bolting together companies with different but related market offerings. Medical contract manufacturing has been restructuring for the past few years, partly in response to healthcare system cost squeezing. CMOs are highly fragmented, competitive, and they lack market power. The typical onshore product offering is largely interchangeable prototyping and low to medium volume high mix manufacturing. While it may not be easy to move that once the OEM has established outsourced production with the CMO, a likely pattern is to hold that existing sourcing agreement in place for more highly engineered, difficult to transfer items, but get fewer and fewer RFPs for new product development, new product introduction, and follow-on manufacturing runs. Large device manufacturers publicly state their intent to pair supply chains, just like the aerospace industry have done before. Shifting to a more strategic sourcing model will lock in relationships, making it harder for everyone else to get contracts. The net effect will be fewer suppliers, which gain recurring revenue relationships. Recurring revenue is much more valuable to investors than one-off jobs revenue. You may have read some of this discussion in trade journals. It's a widely held prediction for the future of U.S. contract manufacturing. The low volume, high mix segment of markets like Medtech, aerospace, instrumentation, and sensors increasingly will be served by super regional, single source suppliers serving almost all the OEM's needs from design engineering through production, with offshore manufacturing availability when warranted. As one large device OEM told a contract manufacturer CEO, the ideal size will probably be somewhere around 50 to a couple of $100 million in revenue. Big enough to meet our needs, but small enough to be responsive and nimble. Fewer and fewer of today's under $25 million annual sales companies will hang on unless they offer the market something really unique or start producing and selling proprietary products. Here's a half dozen examples of the buy and build consolidations I mentioned. There are plenty more. The two at the top are publicly traded companies, but all the rest are funded by private equity investors. I know of and track many of the active strategic and financial investors. Pre-COVID, I was tracking 144 looking for, quote, plastic manufacturers, 79, quote, injection molding, 99 advanced manufacturing, 27 for medical CMOs specifically, 139 for CMOs generally, and 32 EMS. And I know for a fact these numbers were not comprehensive. The result of the consolidation is that the market is being populated by a whole new competitive set. The competition is increasingly becoming private equity funded entities. They're well capitalized, have the board resources of highly professional management, offer a full portfolio of services and production technologies, often under one brand, and can serve clients through multiple locations, often domestically and foreign. This trend is why for the past several years, I've been telling owners that there's a musical chairs dynamic. In that childhood game, nobody wants to be left without a seat when the music stops. Markets change around company owners who don't consciously plan either their capital and operational investment to maintain a competitive edge or plan their exit. Timing really matters. The forces of innovation in a market can either propel a company's growth or shove it aside. It's critical to be aware of the various innovations as a starting point for creating a proactive plan to direct the business to either take advantage of the trend, which typically does involve some investment spending, or consciously decide to avoid doing so for whatever reason. Here are just a few innovations that might have profound influence. I place this section in the unfavorable grouping because many companies will not likely benefit. However, the impact of this is individual company to company. According to a study conducted by 3D Hubs in Amsterdam, the total value of 3D printed parts increased 300% last year. It's increasingly important, having long ago moved from just a prototyping technology. In my opinion, not offering it is a perilous position for most CMOs. A few years ago, I wrote an article saying that today, 3D is a competitive advantage, but in a few years, a necessary capability. Are we there yet? Carbon 3D in Redwood City is promoting their production efficiency from 1 to 1 million units. Even still, some people say additive manufacturing is just suitable for prototyping. In the case of some parts and assemblies, absolutely yes. But clearly 1 million is production scale. BMW had already printed its millionth part a year and a half ago, and to my knowledge, HP has been working with Volkswagen to scale into production at least that long. Last year, GE introduced a turboprop engine partly made by 3D printing that reduced testing from 12 to 6 months, weight by 5%, but get this, 855 parts were reduced to 12 printed additively. The economic benefit's obvious, so of course this will be a major driver of change for plastics, mold making, and machining. Though I'm not predicting the demise of these, only a new and in many cases diminished role in the supply chain as time goes on. TV didn't kill radio either, it just reallocated the market. Simultaneously, a new business model is emerging, an Amazon, so to speak, for precision manufacturing. Just as software as a service, abbreviated SaaS, is today's predominant delivery model, these companies' quote-to-order platforms are promoting mass manufacturing as a service. This one is 3D Hubs in Amsterdam. As you can see, they have some very impressive clients: Audi, ABB, NASA, and HP. They're not the only one establishing this service delivery model. Another's venture-funded Fictive, F-I-C-T-I-V. Still another is Xometry, spelled with an X. An EMS variant is venture capital-funded Tempo Automation, which claims to be the world's fastest electronics manufacturer for prototyping and low-volume production of PCB assemblies. Finnish company Tactotech, a developer of injection molded structural electronics, integrates flexible printed circuitry and discrete electronic components in 3D injection molded plastics. The technology supposedly has many advantages, as indicated on the slide second bullet. They've raised $23 million from venture capital firm Ascend Capital Partners and 2 strategic investors, partly to expand their presence in the US. This innovation has significant implications for both plastics and EMS providers. Information and medical technology convergence is changing the market. Who would have thought 10 years ago that these companies, Apple, Google, Facebook, Amazon, Sony, Microsoft, would enter the medical device market? Digital health applications are rapidly becoming integral to treatment protocols. Just within recent months, have healthcare system reimbursements changed to further support digital health by incenting MDs to work with connected care platforms. This one change alone will have trickle-down effects on the medtech manufacturing market, such as increased demand for data capture and management, minuscule electronic sensors, microfluidics, telemedicine, and remote monitoring. 5G will be in greater demand to support remote work, monitoring functions, and the transport of huge imaging files to enable remote diagnostics. Assembly of more complex devices with unlike parts and software integration will become ever more in demand. So what's the implication of that? Well, you might consider getting health informatics and medical device software ISO certifications. The trends will benefit those who are ready for them. Engineering and prototyping contract manufacturing work for some providers is somewhat driven by venture capital, VC funding, especially here in California. Here are a few key facts to summarize where things stand. Deal count in the first half of this year didn't drop as far as many had expected because investments in later stage companies largely continued. The second quarter dropped 20% versus the average quarter over the past 3 years, but relative to expectations, this could almost be considered favorable. Predictably, VC support for early stage companies dropped substantially from the trend, fleeing risk. Implication for that is fewer new companies in the pipeline may not bode well for future contract manufacturing business. Corporate VC participation in deals rose substantially this year. Again, this suggests that CMOs which hold tight relationships with corporations that are participating in VC, those strategic sourcing suppliers I mentioned earlier, are more likely to gain downstream business. It also suggests that the corporations which may have flinched at stratospheric valuations before may now be deploying held back capital. CVC investment, corporate venture capital, and healthcare has been especially strong during the pandemic. The technology-healthcare intersection is the place to be now. There are many investment spending needs to remain at the forefront of advanced manufacturing. The elements on this slide in the aggregate represent what a healthy and market trend resilient CMO will look like in the manufacturing 4.0 reasonably near future. Well-funded companies, whether public like Proto Labs or private equity invested, are heading this direction, if not already there. Those not continually investing will become less competitive day by day, continually eroding value. In manufacturing, a key performance indicator for a factory is overall equipment effectiveness. Current manufacturing sees 65% is good and 85% is world-class. Knowing what is happening to the minute detail offers a path to improve this key performance indicator. Increasing the presence, frequency, and accuracy of plant instrumentation is the first challenge, and the economic value of that knowledge is the reason for such a steady growth forecast. Depending on where you sit, this trend either represents a cost to keep up with the market or an opportunity to fulfill the demand, as IIoT will generate a lot of electronic manufacturing over the coming years. To address the investment and implementation needs supporting new technologies, many companies have turned to equity investors, whether those be private equity funds or family offices. Almost 30% of US middle market companies have either taken some PE investment or been acquired by one of the other companies in which the fund's already invested. It's a lot easier to fund growth that way, and the financial upside potential can be fabulous for operating shareholders who stay on board as operators and co-investors. As I said, the more PE-funded companies in a given industry, the harder it will be for the other private companies to compete. Owner demographics. Half the over 5 million private US employer firms are majority owned by someone who's 55 plus years old, 20% by 65 plus years old. Thus, over 1 million employer companies are ready to change hands, with another 1.5 million queuing up right behind them. It's harder to sell a company for its highest price and best terms when there are a lot of similar companies in an industry on the market. The more businesses seeking buyers, the more bargaining power the buyers will have. Simple supply and demand. As this daunting Moody's Analytics slide shows, there are far more Americans over 65 years old than younger ones. That crossover occurred just after the last recession. The red arrow points to where we are now in the timeline within that gray band to represent a recession. Notice how the gap has diverged between the yellow line, Americans age 65 plus, and the green line, age 20 to 64. In this context, they can be thought as proxies for inclusive of some owners of retirement age and a proxy for US working age population inclusive of some prospective acquirers. It's not definitive, but could indicate a diminishment of private company exit options as more baby boomer age owners decide to sell into a market that can't absorb the volume. Tax law changes. The 2017 Tax Cuts and Jobs Act has a provision that treats interest expense less favorably in 2022 and phases out the ability to expense furniture, fixtures, and equipment starting in 2023. The interest expense effect will be unfavorable to net income, which reduces valuation. Yeah, while deals are typically negotiated using EBITDA as an earnings proxy, net income is certainly factored in. Simply, a company with less net income potential will transact at a lower multiple of EBITDA than one with higher net income potential, logically enough. Skilled labor shortage. The more complex advanced manufacturing becomes, the harder and more expensive it is to hire. Having these 5 key skills to support the 4th manufacturing revolution raises the hiring difficulty. Computer skills, robot and automation programming, critical thinking, always handy to have, working with tools and technologies, digital skills, including design for additive manufacturing, DFAM. The forecast number on the right was pre-COVID. So what's the implication? Half of manufacturing executives surveyed pre-COVID said that not filling open, skilled job positions would hinder the company's ability to meet customer demand. Of course, this would cap growth and inflate wages. Obviously, the dynamic has changed somewhat recently on both the customer demand and labor supply sides. Regardless of labor supply, social distancing caps personnel count too. The skilled labor shortage is predicted to surge demand for manufacturing automation technologies like robotics, at least doubling over the next 2 years. This requires significant investment. There's another driver there too, and that's lower labor costs enable US manufacturing to get closer to overseas production costs. Now we'll shift into the favorable column of factors. The world is rebalancing geopolitical relationships and supply chains. Here's some insights, a few facts, and emerging trends that may have direct relevance to your business. While finance industry survey respondents worried over tariffs and a trade war in January, I think it's fair to say that the US-China relationship's tone has increasingly moved toward geopolitical conflict and quest for leadership position. And that's not just the US. Many countries are questioning whether they have let themselves become too dependent upon one country's role within the global supply chain. The COVID PPE shortages and subsequent flood of counterfeit PPE escalated the priority of that question. On top of that, there are many other increasing concerns for the West, such as China's militarism, exerting control over Hong Kong, and threat to withhold rare earth element supply as a bargaining chip. In any case, the West's relationship with China is changing. This has direct implications for all USA business, but especially CMO and EMS businesses. The US government dispute with Huawei is far broader than whether Beijing can use a backdoor in their technology to access proprietary network data, though that concern shouldn't be minimized. It's more broadly about US versus China. Who will lead the future? Our leadership is not assured. The Semiconductor Industry Association sums up the battle for digital leadership when describing the key, quote, must-win technologies of the future: AI, quantum computing, and high-capacity digital networking, which we know today as 5G. There are huge implications that are far too detailed to discuss here. China states their intent to exert technological leadership in 5G, AI, and machine learning, but they're weaker in semiconductor design and engineering, which is a key component. For now, we're defending our leadership there with export controls on semiconductor manufacturing equipment. Currently, Huawei is the global leader in deployment of 5G technology by a wide margin. Deployment is not to be confused with design and engineering leadership, which we allegedly still hold, albeit tenuously. China is aggressively building out 5G infrastructure and embedding the technology in phones much faster than the US. Notably, a bipartisan bill in the US Senate to promote and support the US semiconductor business to compete against other state actors trying to wrest away our leadership. Separately, the US and Arizona are in talks with Taiwan Semiconductor Manufacturing Company to establish a state-of-the-art US semiconductor fab, scheduled to begin production in 2024. One could expect favorable spillover effects for all the semiconductor value chain participants, including US EMS companies, if it happens. Production cost is an obvious concern. This pandemic has accelerated a few existing trends favorable to CMOs and EMS. Business's transformation to digitalize more and more of the business. This is beneficial to electronics in the broadest sense, and especially pertaining to IIoT and autonomous vehicle enablement. Medtech's on this path too, as we already discussed. Prioritizing what is essential to build and store domestically to protect supply in case of sudden demand or shortage, especially medical devices and consumables. And a catalyst to rebuild some US manufacturing, but highly digitalized, not legacy technologies. In fact, the latest Thomas Industrial Survey assessing the ongoing impacts of COVID-19 on North American manufacturing revealed that almost 70%, 69% of manufacturing companies are looking into bringing production to North America, compared to 54% in February. The graph indicates monthly responses to the question, how likely are you to bring more production/sourcing back to North America after this outbreak? The red arrows indicating increases in respondents saying likely, very, and extremely likely. The survey sample was gathered to reflect the profile of American manufacturing, with almost 80% identified as OEM or custom manufacturer, about equally split. It's apparent that some reshoring is likely. CMOs and EMS companies will benefit, but there's an inevitable unit cost penalty for volume production, which will have to be addressed case by case. Since about 40% of those expressing reshoring intent were OEMs, reshoring would seem to benefit domestic CMOs with incremental business. Well down the value chain from semiconductor manufacturing, we know that US contract manufacturing has long been established in Mexico. I expect Mexico to benefit from more production shifting there, and perhaps even other select Latin American countries. The interest rate. In response to the COVID crisis, governments around the world reduced the cost of money. Our so-called risk-free rate, 10-year treasuries, yield less than 0.7%, more than a point less than in January. Well, when the cost of a risk-free investment drops, investors' return expectation threshold for an investment with risk typically drops somewhat too. So even if a company's cash flows may now be less than pre-COVID, this effect mitigates the damage that cash flow reduction would otherwise cause to its valuation. And if a company is well positioned for future growth, but lost revenue and earnings due to COVID, that'll also mitigate the COVID damage to their valuation. The flood of private investor capital is the most important factor to owners concerned about their company losing value now. There is a supply and demand imbalance in the market. In 2019, yet again, another record amount of private equity investment funds were raised to invest in private companies. That leaves us now with about $1.5 trillion of money to invest. In the middle market, this private capital is most often used to fund growth, acquisitions, shareholder buyouts, management team buyout or buy-ins, intergenerational family transfer, or majority recapitalizations in which the investor buys a controlling interest, but the operating shareholders continue to run the company with their team to achieve agreed growth goals for mutual gain. In a few cases, it's used to take public companies private. The pre-existing investor competition for the best companies did not change. There's more capital than private companies in which to invest that normally boosts sales prices, as we've seen over the last decade. I think that the net effect of the capital flood will be to bring the market back into balance, but accounting for COVID effects by buyer-seller risk sharing and or price adjustment, rather than shifting all the power to acquirers and investors. The capital flood is why I predicted earlier a market valuation shift to historic norms, rather than a hard tack from sellers to buyers market. Equity investment in private credit capital still needs to be spent. COVID didn't change that. COVID-19 just reduced the universe of companies that will attract investment. And companies perceived as recession resistant will gain favor. Companies that maintained revenue, or especially if they grew it, over the past 5 years will have a powerful negotiating position. Which brings me to Medtech, otherwise known as healthcare devices and supplies. It's a good place to be now. Late in 2019, demand for medical manufacturing was already surging, as indicated by supplier search volume on the largest and 122-year-old business-to-business network, thomasnet.com, now a data and platform company. The left column shows the specific searches. In other words, companies were seeking this sort of supplier. The right shows the year-over-year percent increases. The upstream growth drivers for EMS appear favorable. Since TSMC is the world's largest semiconductor foundry by far, public equities analysts consider them a bellwether for the whole electronics industry. As shown on the slide, guidance they recently gave analysts was very bullish. They mentioned 5G and high-performance computing megatrends, but add to them a fresh new one. Home networking and home entertainment are part of our new normal now. And this means that there will be a surge in demand for the technologies which enable computing and communications equipment to work efficiently and effectively. All this will drive electronics manufacturing upstream of and for first and second tier EMS, but I would speculate on some downstream flow to third tier as well. It's uncertain now whether the previously forecast almost 11% growth rate for medical manufacturing will be the right number, but the population trends driving that number in the first place still exist. And we now have new medical manufacturing demand. For some medtech manufacturers, I think COVID enhances the perception of recession resistance. On the other hand, it's harder to operate profitably during recession. Not everybody will succeed at that. Note that this forecast was for medical contract manufacturing. Another forecast source, which focuses on OEM medtech manufacturing, IBISWorld, stuck with their 3% forecast for medical device manufacturing after a recent COVID-19 research update. The implication, if both service sources are correct, is that more medical device manufacturing growth will be going to outsourced providers than done in-house by the OEMs. The bottom line, what do these trends suggest to you? Well, that depends on your goals for the next decade. They do suggest grow or go, invest or divest. Hope for the best is probably not viable. In any case, I'd encourage you to make an active decision. I suggest that owners ask themselves, am I going to be better off putting more money into the business to stay technologically competitive and independent, then holding the company long enough to reap the rewards while swimming against industry trends? Or am I going to be better off divesting part or all of the business now and putting the proceeds into a portfolio of diversified investments? Think about this. Since 1957, the S&P 500 has delivered a 7.96, so almost 8% average annual return, with, of course, as we know, a lot of up and down along the way. Private equity investment returns are above that. For qualified companies, bringing in private equity investors and investing alongside them is a brilliant move. I keep a quote on my office wall from Andy Grove, who was a co-founder, CEO, and chairman of Intel during its greatest growth years. There's at least one point in the history of a company where you have to change dramatically to rise to the next level of performance. Miss that moment, and you start to decline. I suggest that operating shareholders consider, are we the right people with the right skills to take the company to that next level? Are we adequately capitalized to do so? As shown on this options matrix, owners have 4 basic strategic options, each with a different risk-reward profile. I won't take you through them now, but we'll happily do so if you contact me. Now here's the commercial. Don't worry, it's short. How we add value to achieve a successful transaction. Private capital and M&A transactions exist in a broad universe of considerations, as indicated by the graphic to the left. The entire process must factor in each concept in the bubbles, starting with the majority shareholder's personal needs. The points to the right summarize how we add value. Establishing valuation, the first, is best described as an expected range. A company can have a dozen different values at once, depending upon the objective of the valuation. A formal fair market valuation is only needed sometimes if the company is going to market in a competitive process in which buyers submit offers. If that's the case, the market determines the value through a process of price discovery, which typically is higher than fair market value, an IRS statutorily defined standard. To manage the process, we'll employ a proven multi-step regimen to confidentially run an efficient and well-planned transaction to attract the highest available value and best terms. We lead the negotiation process and counsel you throughout. Of course, each buyer is different, so each negotiation is unique and often simultaneous and time-consuming. Adding credibility. If the buyer already knows they will not be the only one negotiating for the deal, they would prefer to have the company professionally represented, as everything goes more smoothly and the transaction's more likely to close after investing a lot of work in it. Preparing the company. After extensive analysis, we'll make appropriate recommendations. Most companies are not as optimized as they may think they are. Identifying and contacting. Most owners have met someone at a trade show they think may be interested, but often that's not the best choice. Often it's a company the owner never heard of. We conduct a targeted strategic search of those for whom the company would be most valuable. Structuring a transaction can be a complex negotiation itself and typically driven by tax implications, which are in the opposing interest of each party to the transaction. So what's good for one is bad for the other. Educating and coaching owners. We're there the whole way, managing the process to ensure that you know what to do when and what we're doing to achieve the goals. And freeing owners to focus on growth. When a company is on the market for sale or investment, the owner needs to focus on growth, only getting involved in the process as needed. Otherwise, they'll find themselves having taken on a second job, perhaps at the company's peril. If you want a higher valuation, you want your company to be sold, not bought. Unlike public companies, private companies require pushing to sell the equity in an otherwise illiquid market. At any given moment, the trading price of a public stock reflects its market demand. At any given moment, the market demand for a private company ranges from zero to whatever offer walks in the door, to the value established by a competitive process in which parties submit offers. The key to obtain highest value is a well-executed process that generates competing interest from multiple parties. It's not uncommon for a well-executed M&A process to achieve a sale price much more than the fair market value. For companies whose assets are principally intellectual property and/or in markets in which only a select few people see the growth potential, it may be a multiple many times over. Here's a great example of that. Facebook bought early stage Instagram for $715 million. Well, it's now second only to Facebook in highest social media daily engagement rate, well ahead of Snapchat and TikTok. Effectively, they created another $20 billion annual revenue company for only $715 million initial investment. Finally, one note of parting advice. Don't passively await unsolicited offers. Preparation determines who captures the company value. One study of middle market sellers shows that 55% of sales were initiated with intention to sell and 45% reactive to an unsolicited offer. That second group would seldom get their full value. The vast majority of seller-managed transactions fail to complete, and sometimes the owners get so distracted the business declines, destroying value that the buyer then wants to renegotiate. As a word of caution, if you've contemplated running a transaction yourself, but never done this, I'll quote Mark Twain, who said it so well. A man who carries a cat by the tail learns something he can learn in no other way. Third-party studies quantify the value professional transaction advisors bring, such as one in which 95.7% of people who sold their company with a professional M&A advisor said the advisor got the price up 10% or more. Want to know the statement that'll get you the value you deserve when an unsolicited offer comes in? It's, let me give you the contact information of my investment banker. And here's mine. When you hire us as your investment banker, the preparation process begins immediately. We'll usually be able to establish a competitive dynamic, which doesn't exist when a potential buyer calls to express unsolicited interest. Not only does that inquirer hope that you'll not want to shop the company to others, they'll want to take control of the process to the degree that you'll allow that, and add tens of hours a week to your workload, all the while diverting your attention from running the company. If you'd like to have a discussion, please call or write at the information on the screen. Thanks for staying with me this far.